everybody today with a huge number of sets of results out. So apologies to everyone who's skedaddled here from other meetings and no doubt going on to others after this today. So thank you for being here, and I'll hand straight over to Ken for our results presentation. Thank you, Ken.
Thank you, Lexi. So good morning, everybody. Add my welcome to Lexi. It's very good to see you all here today for our 2013 results. So what we're going to do is I'll say a few words by way of introduction and then just really talk about each of the business areas so you can see the progress we're making there. David will then cover the financial part of the presentation, and then I'll come back and then talk about business development and the outlook for 2014. So I think 2013 to me was part of the continuation of the transformation of Xchanging. We did simplify the structure a little bit, so we exited the investment in Xchanging Transaction Bank, the securities processing business, although we still do securities processing from India for Deutsche Bank. We redefined, if you like, our offerings to the market to make them very much more focused. So we've got a clear set of offerings to the market. We also stepped up a lot of the selling and marketing effort, and so that's increased the sales momentum in the business, and also started to change the way that we operate, the so-called Going for Gold program, which I'll talk about a little bit later on. 2013 was a good year for financial performance, so adjusted operating profit up 10.1% to 55.5 million, and the operating margin on net revenue moving above 10% into double digits, which is very encouraging. Of course, we ended the year in a very strong financial position, so net cash, added to which, of course, we've recently refinanced our bank facilities, which gives us certainly a lot of headroom to be making further investment, and we'll come back to that a little bit later on. Of course, we increased the dividend to 2.5 pence, which from the penny dividend that we introduced or reintroduced last year. Of course, going forward into 2014, the transformation will continue to progress as a result of choices that we've made. In 2013, we do have some challenges ahead of us. So what we will be doing in 2014 is stepping up investment. And our aim really is to maintain the adjusted operating profit of the business and really set ourselves a platform for the resumption of revenue and profit as we go into 2015. Just remind ourselves what the objectives were for 2013. We said that we would achieve year-on-year improvement in financial performance, and I think based on the results today, I think we can say that we did achieve that. We said that we would win business from new customers. In fact, we've had a lot of business wins during the year. So some that I guess I mentioned would be SMMT, which is a technology opportunity which we've won, Severn Trent, which was procurement opportunity, Everest Re, which we'll come to, which was Zuba. So those are good examples of business wins, and also Diageo in procurement. So I think we can have a tick for that. And then from existing customers, again, we've seen a lot of business wins from existing customers. So Aon, BAE in technology, Godiva in the procurement business, also Gatwick, another technology opportunity which we've won, and Toyota, workers' compensation in Australia, and Vodafone, which are another procurement services. So again, I think we've seen some good wins of business from existing customers. And I think finally, an objective which we set for ourselves, which is very important to me, and that is this setting of this idea of one exchanging, so everybody working together, driving the business forward. Probably recall I've spoken before about this silo mentality that we previously had as a business, and I was very encouraged recently when I went round the business in India, Singapore and Australia, just to see how motivated everybody is towards driving forward this notion of one exchanging. So I think in terms of the objectives we set for ourselves in 2013, I think we've made we made pretty good progress against those. Just referring to some of those business wins, because I think these are actually very important wins, but they also highlight particular trends. So the Ministry of Education in Malaysia, that in fact, the real customer there is a company called Hope Tech, but we're working alongside Hope Tech for the Ministry of Education in Malaysia. That's a technology opportunity. Everest Re is a complete Zuba suite for reinsurance. That's the first US reference customer which we will have for Zuba. Of course, we do have legacy software products in the US. And then the SMT opportunity, so that's the Motor Vehicle Registration Information System, where we're providing application development for them. And in addition, we will effectively be providing business processing services alongside that, largely around analytics, in fact, to analyse the information that comes through the motor vehicle registration system. Key aspects of each of those is that new customer, they were actually won in competition. So in the case of Everest Re, we've won that against the major competing products in insurance software. In the case of SMT, we won it against a couple of very large, what might be regarded as blue chip technology providers. So we had a differentiated offering, because to me that's how we win in those situations, is by taking to the customer a differentiated offering that adds value. And of course the other aspect to them is that they involve technology. So very important characteristics of those three particular examples of business wins. I think the other thing that's become clarified as we've gone through 2013 is the business model itself that we're trying to develop. So we have business processing services, essentially is what I call the foundation or the core of the business. Included in there is insurance, the services we provide to the insurance market, not only here in London, but also as we try to develop that business increasingly globally. Financial services is in there, and any of the sort of processing type services which essentially show those characteristics. So here we see markets growing about 5 to 10%. It's well established, lower risk, annuity profits, annuity cash flows, strong margins, and growth potential very much in line with the way that we would see the market growing over time. So that's really the foundation of the business, and it really gives us the opportunity to build then on top of that foundation in the area of technology and in procurement. So in technology, similarly, we see markets growing at 5 to 10%. A lot of that business is currently still in the investment phase, and of course many of the contracts are much shorter duration, have lower visibility, have potentially higher margins, and certainly potential for higher growth. So if you looked at the business overall, I would say technology would be an area where we would see increasing growth. And I think the other important thing just to draw out of that is that technology is about supplying technology services. Within BPS, we also have a significant amount of technology. So, for instance, the work that we provide to the insurance market here in London has a significant technology component. That aspect of the business actually does sit within business process services. So technology is about providing technology services as such. And then procurement, clearly an area where we have market recognition as being a leader in that market. It's actually the highest growing market that we're in, and of course does provide potential for significant growth going forward. So that's how the business model is actually emerging. Maybe just spend a couple of minutes talking about each one of those. So within business processing services, insurance, we've seen some growth here in the London market, very much supporting the activity of the market here. We're trying to, as you know, have what I call a breakout strategy, and that's to go into other markets. So to take the capabilities that we have here in London and take insurance processing as a service into other markets. So you may have seen an announcement where we've opened a small insurance office in Singapore. We've been stepping up the sales and marketing activity in the US. We've been redirecting the claims business really in response to the claims transformation program here in the market, and a lot of activity going on from a technology perspective. You have seen earlier on last year actually, the launch of Expresso and a number of sort of follow-on products that have been coming through. So clearly an area that we want to build on. We want to really take that business globally, and I think we're making some good progress there. Financial services has been a year really about change. We've exited the investment that we had with Deutsche Bank in securities processing. We've also been focusing on bringing together the Kedrios business and AR Enterprises to form Xchanging Italy, and we're making good progress there. And then the other area within financial services which we're progressing is really looking at the reorganisation of that business, giving it a much better technology front end, but also trying to drive cost out of that business as well. I think we've made some reasonably good progress there as well. Other aspects of business processing services are really around us trying to develop new capabilities, new vertical markets. So we have an increasing presence in real estate, we have an increasing presence in the telecoms, logistics markets, an increasing presence in healthcare. These are all areas that we want to try and build on and take forward, and very much focusing our efforts, our sales and marketing efforts, into those areas where we have true capabilities, so that we can build on those capabilities as time goes on. So I think overall some pretty good progress in business processing. Technology, we've really said that we want to focus into 5 areas. We've got what I would call the core areas, so that's application services, so that's things like application development, application maintenance, support, which is the bread and butter, if you like, of that business, and we tend to try and target that at a specific market to effectively avoid some of the very major competitors in the market, or as I said, we have competed successfully against them by taking differentiated offerings. And the other area which is core to that business is the partnership with Dassault Systems in engineering services. And then exploring new areas, so education platforms. The business with Ministry of Education is an extension of the work that we started in the previous year with the Ministry of Education, rolling out the e-learning to primary schools in Malaysia, and that's an offering which we want to try and take into other countries. And then, of course, the Internet of Everything is a massive market, growing very significantly, and we're trying to develop a particular niche in that market. It's still exploratory. Our niche is built around the application program interfaces and providing the development work for those, and analytics built on the top of that. We're not trying to compete in all the other space in terms of networks, infrastructure, devices, and so on. So Internet of Everything is an interesting area. And, of course, the growing Zuba insurance software business. So maybe just a couple of words on Zuba. We have seen good revenue growth in the year, so 2013 versus 2012. We do have a strong pipeline in that business, and our focus, of course, in 2014 is to convert that pipeline into revenue. But investment in the business does continue, and so we have launched, or will launch, the software into the what we call the US admitted markets. That will require some investment in the business. We've seen our first US reference customer, which I referred to earlier on, as a business with Everest Re. And then more recently, we had the launch of Zuba for London. So this is the marketplace where we're likely to see the earliest penetration into that market. We also introduced into it this idea of the Upgrade Studio. And what the Upgrade Studio does is it enables companies that have legacy products, it eases their transition of data into the new Zuba suite. So again, I think we've made some good progress on Zuba. I'm expecting more progress and faster progress as we go into 2014. Procurement, as you will have seen from the numbers, had a tough year, but it's slight disappointment really in terms of the performance, but it's still pursuing a particular plan. You know, we always knew that we had to reconfigure the business in Europe once the nature of the BAE contract here in the UK changed. So we've been going through that process. An encouraging feature of the business is the new work that was won during the year. So really will flow into 2014. So we have been investing for the future in that business. But a very exciting thing, I think, which occurred during 2013 for the procurement business was the acquisition of MARKETMAKER 4. And MARKETMAKER 4 essentially is accelerating the technology program for our procurement business. There's been a need for us to establish a technology platform within procurement. MARKETMAKER 4 enables us to do that. It also brings significant synergies. It brings new customers that we can sell other exchanging services to. It adds value to our existing procurement service that we offer. Of course, we can cross-sell into other exchanging customers as well, and it extends our reach into the US because it adds something of the order of another 40 or so customers in the US market that we can hopefully start selling other services to. I think the great thing about the business is that since the acquisition, the customer base of that business, so the acquisition was in September last year, the customer base of that business has increased of the order of 50% since we acquired the business, and lots of opportunities being pursued currently within MARKETMAKER 4. So very encouraged by the developments there. Finally, before I hand over to David, just a brief word about going for gold. I spent a bit of time at the half-year stage just explaining what we were doing here, so I don't want to spend a lot of time on this. But this is about the way that we operate and how we can improve what we do. And the impact of going for gold is clearly that we are now emerging as what I call a sales and marketing-led organisation. It is leading to greater standardisation and simplification of the way that we do things, which will enable us to take cost out of the business. A lot more to do on this. This is part of a continuing programme. It's part of continuous improvement, but still a lot more to do. We are creating opportunities for longer-term efficiencies to take cost out of the business. And I think the very compelling thing about this is that when we ran our employee engagement survey for 2013 was just the buy-in now from employees around the whole of Xchanging into the whole concept of one Xchanging, innovation, the importance of technology, the strategy that we're pursuing as a business, and the real focus on trying to build on the success we've built so far within the business. So the Going for Gold programme kind of goes along in the background, but it's a very important initiative just to change the way that we operate. So with that, I'll hand over to David.
So thank you, Ken. So good morning, everyone. Ken's given you an overview of the financial performance for 2013. I'll go into a little more detail on the group results and then on the performance in each of the three business areas. So I put some slides in the appendix covering areas of detail such as pensions, non-controlling interests, cash flow and tax, as well as the revenue and profit bridges. So as Ken said, we think the financial performance in 2013 reflects the progress we've made in our transformation, and it places us in a healthy position to manage the headwinds that come from the already known and mostly planned contract profit reductions in 2014. So the delivery of our plans in 2014 will mean we're able to look forward to a move back to earnings growth in 2015. So looking at the financial indicators, once again, we've been able to deliver year-on-year improvement in operating profit. Net revenue grew by 2.7% on a like-for-like basis. We've achieved an increased 10% margin, and we repaid all of our debt in the year. We've returned to a normalised level of dividend. Although cash conversion was lower than last year, this is largely the result of the start of an investment phase in the business. So let's look at some key financial indicators in some more depth. Since 2011, we've grown the operating margin and we've shown a healthy rising level of economic profit. We favour economic profit as a measure of performance, and we include it as a feature of our long-term incentive plans because it captures both post-tax profitability and the efficiency of capital in one measure. In 2013, our economic profit benefited from the lower tax rate achieved this year. Since 2011, we've seen the tax rate fall from 36.3% to its current 26.9%. And we aim to further reduce the tax rate going forward. So turning to earnings per share, since 2011, we've been cautious about discussing our expectations on this measure. This is because the non-controlling interest figures for the Xchanging transaction bank, the XTB, distorted the commercial reality of shareholder earnings. So with the disposal of the XTB in 2013, earnings per share will be a meaningful metric by which to judge our performance going forward. And I've added some bars to show the EPS excluding the accounting adjustment we've had to make for the XTB non-controlling interests. So looking at the income statement, statutory operating profit was our highest ever recorded at 81.9 million. In terms of the rest of the income statement, the only areas I want to expand on here are the exceptional items, so I'll move and cover those now. The disposal of the German securities processing business resulted in an exceptional profit on sale. This was in line with our previous guidance at 12.5 million. The next item was the surrender of our lease in our London premises. In terms of the lease surrender, the net favourable impact of the surrender income, less move costs in the period, was 13.3 million. We will receive a further compensation payment when we exit our current London premises in the first half of the year. Net of relocation-related expenses, we expect this to be a cash and P&L gain in 2014, and any benefit will again be treated as an exceptional item. Restructuring charges of 6.2 million were incurred in the year, and that was mainly relating to the financial services business. We expect to incur some further restructuring costs at a similar level again in 2014. We recognise 5 million as a fair value adjustment on the earn-out relating to the Italian business AR Enterprises. The final payments to the vendors will be at a lower level than we first thought, and I'll touch a little bit more on this later. We had further smaller exceptional items relating to income from the liquidator of the Siski business in the USA and the release of the New South Wales onerous contract provision, which we booked in 2010, as well as some small employee-related items. So with the exceptional items now explained, I'd now like to turn to look at cash. So I'll start with operating cash flow and then look at non-operating movements. The first slide reconciles from adjusted operating profit to operating cash flow. The first highlight here is the favourable impact we had from the exceptional and other adjusting items, such as the cash flow from the surrender of our lease. You can also see that the relationship between capital expenditure and D&A has changed in 2013 as we've started to invest in the business following a cautious period of low investment. Ken will talk about our investment plans a little bit more in a moment. Compared with the positive working capital movement seen over the last 2 years, we saw an outflow at the end of 2013, but we do not envisage this to be a trend. So turning to look at the overall movement in net cash, you can see that tax payments on trading profits for the year were higher than in 2012. Of the 17 million payments in 2013, 12 million were for normal operations in the year, and an additional 5 million related to exceptional payments made in the year to cover tax arising on the surrender of our lease in our London premises and settlement of taxes in respect of prior years. Equity-free cash flow from operations after cash tax and interest paid in the period was an inflow of 33.4 million. The disposal of the XTB in the year enabled us to repay all our debt and fund the acquisition cost of MARKETMAKER 4. Details on cash inflows and outflows on acquisitions and disposals are shown in the appendix. So turning to the group's cash position, I've listened to the requests from analysts and investors to simplify the reporting on our net cash. This is particularly important given our intention to invest both organically and through acquisitions over the next few years. Therefore, in addition to the statutory reporting of net cash and the additional reporting of balances in enterprise partnerships, we'll now provide a single figure for Xchanging's share of net cash. There's further detail on this in the appendix. The measure selected is both the simplest and the most conservative measure of those considered, and I hope this will help investors to assess our progress. Xchanging's share of net cash grew by 30.5 million over the period. So I'll run through the results sector by sector, but firstly on the corporate centre. Corporate costs were 15.2 million. While we've been reducing our recurring corporate costs, this has been offset by investment in the One Xchanging change programme. Although the overall margin for the group has now reached 10%, you can see that the margins across the three business sectors vary considerably. It's our aim to increase the margins in the technology and procurement sectors so as to be more in line with those in business processing services. In the case of both procurement and technology sectors, we're developing the higher value offerings which will enable such a growth in margins over time. What you see in 2013 are businesses partway through that transformation. So I'd now like to review the operational performance of the business by sector, focusing in particular on how each area is positioned to manage the impact of the profit regeneration challenge in 2014. So starting with business processing services, the largest part of the sector is of course insurance services. Growth in London market volumes and a good performance in the Australian workers' compensation business led to increases in both revenues and profits, despite lower revenues in broking services. Within financial services, revenues inevitably declined as a result of the disposal of the German securities processing business during the year. Two things helped to mitigate almost the entire revenue decline. Firstly, the revenues from the acquisition of AR Enterprises, and secondly, growth in our investment account administration business, Fonds Depot Bank. We expect Fonds Depot Bank to be a contributor towards the profit increase required to offset the disposal of the XTB in 2013. As I mentioned earlier under exceptional items, we've adjusted the deferred consideration on the acquisition of AR Enterprise, as the profit expected in 2014 is lower than the very challenging target we set at acquisition. However, we still expect the Italian business to return double-digit margins, and it will also be a contributor to the profit regeneration challenge. This would not have been the case for Kedrius as a standalone business. Together with an improved performance from insurance, we expect business processing services to maintain its performance in 2014 despite the disposal of the XTB. Moving on to technology, although we saw a small decline in profitability, we're pleased with the development of the business overall. Notable contract wins, such as the Ministry of Education in Malaysia, as well as growth on existing accounts such as Gatwick Airport, are pleasing. 2013 was the first full year of contribution from the Marsh Zuba contract. The continued investment in Zuba reduces our current profitability, but it provides the potential for stronger margins and growth in the future. We will increase the investment in Zuba further in 2014, and we expect the growth in the technology business overall to enable the sector to offset the impact of the profit reduction from LME profits in 2014. Turning to procurement, the financial result in 2013 was disappointing and below our own expectations set when we entered the year. However, as we said in November's interim management statement, we've had success in winning new business in procurement in 2013, in both Europe and the North American markets. The acquisition of MARKETMAKER 4 has been significant in improving our technology footprint, and we intend to invest 5 million during 2014 to build out our sourcing technology offering. We believe that the actions we're taking on technology investment, cost reduction and sales growth are tackling the underlying issues which led to the weak profitability of the business. An improvement in the procurement business this year is expected to mitigate the impact of the exit of HR in the UK. The 2013 result benefited from stronger than normal margins on the HR business as a result of a well-managed exit process which completed at the end of the year. So in 2013, we once again met our objective of delivering year-on-year improvement in performance. We started this year by completing our refinancing out to June 2018. The new facility gives us financial strength, but we will maintain the same rigour over capital allocation that has characterised the last 3 years of our journey. As we've outlined, the challenge of maintaining the same level of profitability in 2014 will be harder, but we have confidence that we will achieve this across the group as a whole. In the light of our growing confidence about delivery of our transformation plan, we've reviewed the level of the dividend and decided to propose increasing it to a more normalised level for the performance of the business. Further increases in the dividend will be assessed each year and will be largely dependent on growth in earnings. So thank you for your continued interest. I'll be ready to answer questions with Ken shortly, but first I'd like to hand back to Ken to talk about business development and the outlook.
Thank you, David. So I would just like to really cover 4 remaining areas. Just talk a little bit about broadening the customer base, technology enablement, talk about innovation and differentiation through innovation, and then, as David said, I'll spend a few minutes talking about investment. So I think we've made some good progress, but there still is a fair amount to actually do. As far as broadening the customer base is concerned, we've already made quite a bit of progress here. So we've exited some of the legacy contracts. We have increasingly seen the wins that we've had across the business giving us a broader base of customers, a broader base of contracts. And typically the new offerings that we make into the market also give rise to that broadening of the base. So the key thing is actually how do we grow revenue going forward from here? So the first thing is clearly we need to focus very much on our domain strengths and our capabilities. And so we're able to take offerings into those areas where we have truly the ability to differentiate the offering that we have. Second area, of course, that we need to do is to build on the product offerings that we have out in the market. So 2014 will be an important year for Zuba and to show progress with Zuba. It will be an important year for MARKETMAKER 4 to see progress with MARKETMAKER 4. Also an important year for NetSet for us to try and make some progress with the NetSet offering into the market. And of course there will be others. Hopefully as we go through the year we'll be introducing a number of new offerings. It's also important, of course, to make sure that we work closely with our existing customers. So not only do I talk very much about trying to make sure that the offerings that we have in the market are repeatable and scalable so we can take them to new customers and new markets, it's also important that our existing customers are reference customers for us. I have one of the objectives personally that I want to pursue within our organisation is to ensure that every one of our customers is a reference customer. And we do have a couple of quite important renewals as we go through this year. So the New South Wales contract, the workers' compensation contract in Australia is something which we'll renew in 2014. And so we're very keen, obviously, to build on that relationship and win that and hopefully increase market share for that particular area of business. And as we go into 2015, and clearly the preparation for this takes place as we go through this year, there is a renewal on the AGI contract. That's the Investment Account Administration contract. So two important areas to focus on. And then another very important area to focus on with existing business, not so much a renewal, but nevertheless very important, is our position in the insurance market. Clearly, we've been working very hard through the relationship which we have with Lloyds and the IUA in our joint venture, Xchanging Insure Services, XIS. And introducing a number of new offerings, so Expresso is a good example. Just recently we've introduced data capture services and we're also released what we call Binders 360. So a number of new offerings going into the market and more as we go through 2014. We as a business clearly are very, see the insurance part of our business as a very important part of our business. It's very much the platform, if you like, of the business processing services business, and so we want to continue clearly to be involved in that and invest in the market through XIS as we go through what's called the Central Service Refresh Programme. So we're very keen to be an active participant in that, and that hopefully we'll see some more developments as we go through 2014 there. I think also clearly the other way in which we need to be growing the business is targeting new customers. We did see a number of new customers coming on board as we went through 2013. But it has to be very much in those areas where we have strengths and capabilities, where we can bring value to customers in those particular sectors. That brings me really on to technology enablement. Those of you who attended the technology seminar which we ran in November, and indeed the half-year results announcement, I talked a lot about technology, the impact on our business, the impact on industry, and you'll know that technology can be a significant disruptor, but it also provides great opportunities for our business. And how we're responding to that is to ensure that in each one of our businesses we have a clear technology strategy, particularly focused, as David mentioned, on a technology platform for the procurement business, so investing there alongside the investment we made in MARKETMAKER 4. We clearly need to continue to invest in the development of the existing offerings in the market, so continue to develop Zuba and also to continue to develop MARKETMAKER 4, and also to focus on some new technologies. So Internet of Everything I've already mentioned, mobile applications, the education platform. So these are all areas where we will be focusing on investment in new technology. And that takes us really to the differentiation of the business. One of the things that clearly we've tried to do, I think, within Xchanging, and I believe successfully, is actually introduce this whole concept of the importance of innovation. I mean, ultimately, we need to generate sales growth, innovation drives sales growth, and of course technology is a very important ingredient to driving innovation. And whilst it may seem as though you would expect this to be in every organisation, I think it certainly wasn't something that was present in Xchanging. I think we've made a lot of progress in terms of encouraging innovative ideas. So we have an innovation board, the innovation forum. We've got Ken's Den, which is like Dragon's Den, where people bring in investment ideas. And out of that, incidentally, a couple of the products listed there, so Zoom and BPO 4.0, those were products of that Ken's Den process. So we are encouraging in our business innovative thinking. Again, it's another one of those areas where there's more to do. You can't just turn it on overnight. You can't show up one day and say, I'm going to innovate today. You need to actually get that into the whole culture of the organisation. And I think it is something which where we're making significant progress and will continue to emphasise. So David mentioned I would talk a little bit about investment, because I think this is important. It's something which is going to step up as we go through 2014. So we've divided it here between internal change, refresh, business development and acquisitions, and obviously you can see the years across the top. So 2011 and 2012 were really periods where we were investing at a level below depreciation. It was really just to keep the lights on, doing the things that we actually had to do. 2013, of course, we have seen an increase in investment. We've had the product investments in Zuba, Netset, Expresso and others. We've been developing the technology in the insurance market, so we've been doing an insurance, the refresh of the IMR, so the Insurers Market Repository, so investment going on there. So that's a technology refresh. And we started to make investments in our own internal systems. So the HR platform, starting to invest in shared services. So that's where the internal change investments come in. And so overall investment in capital expenditure terms up in 2013. And of course in 12 and 13, the acquisition of AR Enterprise and then MM4. As we go into 2014, we hope there will be further investment in acquisitions if we can identify the opportunities to fill in strategic gaps that we might identify. They're likely to be similar to MM4, a technology, relatively small business, adding to what we have currently within the business, structured in a similar sort of way. Value that we pay for the business linked in some way to performance of the business. So clearly focusing on 1 or 2 bolt-on acquisitions. We do see the acceleration of Zuba. So I mentioned early on taking that into the US admitted market. We've agreed that we'll invest further in that and take that into a new market, which is not currently available for. Zuba for workers' compensation, and a procurement technology platform, which we've already mentioned, and a continuation of investment in the insurance market technology refresh. Many of you will be aware of the Central Services Refresh Programme. That in itself will require investment going forward. It's something which we are certainly keen and willing to do through XIS. And then the internal change programmes will continue. A number of you are probably familiar. We're moving out of our office in Leadenhall Street, so there will be a new London office. There'll be a certain amount of investment needed there. So in total, we would expect, we can't be precise, but we would expect expenditure in that sort of range as we go through 2014. So I think what's happened there really is we went through a couple of years where we were relatively cautious. As we've grown in confidence in the business and we feel as though we're making progress, we now look to invest for growth and take the business forward. I think if you look at the things that have been achieved overall, I think we've made some good progress. I think we've now got a differentiated set of offerings for the market, a portfolio of offerings for the market. I think we have a management team in place and an organisation in place that enables us to deliver the strategy that we've set out. And I do think that we have financial strength to go ahead and do that. So we're really establishing what I see as a platform for medium and long-term growth of Xchanging as we move through this transition process. Of course, we do have the immediate challenge, which is the challenge for 2014, as a result of the choices that we've made in 2013. And I can assure you, as I go around the business, everyone I speak to is actually up for that challenge. And so we're very keen to start to step up the investment in the business, so increase the pace of change, increase the pace of investment, set our ambitions higher so that as we grow in confidence, we feel that we can deliver more into the market and introduce some new innovative products. To ensure that we focus in those areas where we truly believe we can win. Now, that's important both from the point of view of focusing on the product offerings we have, but also the customers that we target, that we keep our energies really focused into certain areas rather than just pursuing any opportunities that come along. And so in 2014, we will continue to really focus the business into the areas where we truly think we have the opportunity to win. And then, of course, in order to do that, we need to make sure that we invest in talent. So just as I said at the beginning, and we had objectives for 2013, as we go into 2014, the aims that we've got are quite clear, that we want to be able to maintain the adjusted operating profit, so cope with the challenges that we've set as a result of the choices that we've made, and of course set the scene for a resumption in growth as we go through into 2015. And I know, as I say, I go through the organisation, I think everybody is committed to actually making that happen this year. So I think with that, we'll hand over to questions, Lexi.
Very good. And this screen is, as of course you'd expect, a heavily technology-based company. So I hope you're following our tweets and your way. Some of you know this very well already, but there we are. So we've got some microphones in the room. I'm open the floor now to questions. Mike.
Morning. Couple from me, if I may. Just on the dividend policy, go from 2014 going forward, should we be thinking about a particular level of cover or growth or payout ratio? That's the first one. I don't know if you want me to ask questions.
Go on, ask the second one then as well. We'll cover them both.
And then the second one is just on the fixed cost base of the procurement business. Clearly you are looking at reducing costs here, but just whether you can just discuss a bit more the dynamics of that fixed cost base and what the normalised margin of the business should be. And then just a third one, are there any exceptional items we should be thinking about for 2014 as well?
Okay. I'm going to pick up the dividend policy point, and I'm going to ask David to respond to the fixed cost base in procurement and the exceptional items. I think on dividend policy, it's sort of early days really. We introduced the dividend last year, reintroduced the dividend after the cut that was made in 2011. And I view dividend as a very important discipline for a business to ensure that we're very focused about what we do with the equity free cash flow. But I think it's also important that we link dividend to affordability. And so it is very much about getting the balance right between the investments that we need to make to drive the growth of the business and the funds that we have available to pay dividends to shareholders. I'd like to think as we do see the business going forward, clearly we will see a progressive dividend policy progressive dividend over time, but we've not actually formalised a policy per se.
Okay, so I'll take your two questions, Mike. So in terms of I think specifically around the procurement business and fixed cost base, I think it's important to get across that, as I said, we're expecting the procurement business to grow in 2014. Obviously, in that segment, you've got the HR business, so from a revenue perspective, that will go away. We're expecting the procurement business to grow in 2014 to offset, in profit terms, that loss of profit from the HR business, and then to move on from there. I think it's, we should be expecting the procurement business in terms of what levels of margins it can deliver, certainly to get up towards the sort of level of margins that the business processing service business overall makes. But that will take time. Clearly, it's a long way behind that at the moment. And in the European market, there was a massive change in that business during 2013 with the change in the BA Systems contract in the UK to being on a completely different basis. So the business has been going through managing a restructuring process and a reorganisation process for that. But it's a growing business. We've grown the business outside of that in Europe and North America. So it's not as if we're losing customers. We're growing the customer base in the business. And I think the other aspect of it, and that's demonstrated by the fact that we're investing more in technology in the procurement business than we ever have before. So we'll invest £5 million in the technology platform in the procurement business in 2014. It's a major part of our investment programme. And really, what MM4 has brought to us is a part of that package of technology ready-made with a fantastic management team, brilliant product. As Kenneth said, I mean, this is a business that's grown its customer base by around 50% just simply when we bought it in September. So that's a pretty good performance. So while the sort of historic results of the procurement business don't look great, we're very confident about the future of the business. It's going through the transformation phase. I think in terms of exceptionals, so I think I highlighted that we'd expect a little bit of rationalisation, which in 2014, similar sort of levels to those in 2013, again as a part of our transformation programme. And then going the other way, we'll have some further benefit coming from the move of our London premises. So there's quite a big exceptional gain in 2013. There'll be a smaller one in 2014. So I think you've got obviously in total a very big exceptional number in 2013. It doesn't have brackets on for the avoidance of doubt. It's a positive, and you won't see that sort of number in 2014. It's much lower levels of exceptionals, I think, to come.
Good morning. It's David Brockton from Liberum. I've got three questions as well. The first on AR Kedrios. Given the release of deferred consideration there, aside from the reduced profitability relative to budget, I just wonder if you can give us a feel for how the revised payment structure helps you turn that business around and improve the profitability, because it feels like the shortfall is on the Kedrios side. The second question was with regards to the CapEx increase in 2014. I just wonder if you can give us a feel for if there is anything material within that increased CapEx guidance, or whether it's just a general increase on all of the aforementioned points in the slide. And then the final question, if you can keep up, is just on Zuba. Just wondering if you can give us a feel for how that pipeline is developing post-Everest Re. Thank you.
Sure. So let me pick up the AR Kedrios point and Zuba, and I think I'll ask David to comment on the capital expenditure one. So basically on the AR Kedrios integration, what's happened there is the reason why they've not achieved the level of quite ambitious level of profitability when we acquired the AR Enterprise business was actually it's taken longer to transition the customer base from the Kedrios platform onto the AR Enterprise platform. And actually the reason for that was that one of the customers in Kedrios decided not to transition, so we've had to deal with that, and it's meant that we've had to reserve the existing platform for longer than we'd expected. And then one of the other customers we had some challenges with, but in fact that customer has now agreed to transition across, and so it was more around the timing of the implementation plan. Now, in addition to that, we had one or two management challenges, and as a result of resolving the management challenges and really dealing with those customer issues, we've now got a clearer line of sight in terms of the profitability of the business. But of course the earn-out was linked to a particular time scale, and because of addressing the sort of management issues that we had, we basically, as part of that discussion and negotiation, we brought to an end the earn-out process, which is why you end up with us paying a lower consideration for the business. It doesn't have any real impact in terms of the strategic importance of the decision, because that was absolutely right, because it stemmed obviously the losses of the Kedrios business. And in fact the issue that occurred with the customers demonstrated the vulnerability of even what we'd done within the Kedrios business, because as you recall we'd reduced the losses significantly, but it was always vulnerable to a loss of customer. So I think we're happy with where we've got to. There's a challenge for local management to improve the profitability of that business, but I think we've now got a stable setup which we're going to move forward from. I think on Zuba, there's a couple of ways of trying to look at the pipeline. The population of businesses that are interested in software is actually well known, so we have a clear line of sight in terms of the target customers that we go after, and basically what happens is that we go after those and we gradually qualify them down. We've got a very long list of potential targets, which have then obviously been reduced into what we call real opportunities. And no, we're very pleased. I don't want to put a number on it, but we're very pleased with both the number of opportunities and potential size of revenue from those opportunities. The challenge again within that business is just the time scale it takes to convert opportunities into sales and revenue, because they're companies making big investment decisions. So for an insurance company choosing to install a full suite of Zuba modules, it probably touches on 70 to 80% of the people in their organisation. So it's a bit like doing a PeopleSoft implementation or an SAP implementation or whatever. And so it is a big investment decision, and so it takes time to get these things across the line. Very pleased with Everest Re. We announced Ascot, which was a smaller win earlier, just in January. We hope there's going to be another one will get converted fairly soon. And so we are seeing a number of these coming along. And as I mentioned in the presentation, it's an important, if you like, test for us this year as a success factor that we do see conversions of those opportunities that are in the pipeline, so they've been qualified and are in the pipeline, into revenue.
So I'll start, David, with just to follow on from where Ken left off on Zuba. So we've invested, I mean, as Ken said, in the sort of 2011-2012 period, the capital investment in the business was keeping the lights on. And then really the only other area of significant investment was in the continuing development of Zuba, and then smaller projects like NetSet. Our confidence in Zuba as a long-term value generator is shown really by the fact that we'll step up quite significantly the investment in the Zuba programme during 2014. So of that, we gave some guidance there, about 40 to 50 million pounds of capital expenditure is our plan for 2014. And the Zuba product takes up a reasonable portion of that. So we're more or less doubling the investment in the Zuba business in the same way as we're potentially up to doubling the capital investment overall. So it's a very significant investment. Large part of that, for instance, is, as Ken said, the US admitted market, which opens up a very, very big market for us in the US. But Zuba is a long burn cycle. MM4, you could sell a product and have it installed and generating revenue in a month. Zuba will never be like that. It'll always be a year or 2 years. But you can have the confidence that once it's installed, you've probably got pretty much an annuity revenue, a generational revenue. So I think outside of that, it's broadly spread really. So as part of what I've called the profit regeneration challenge, we have to improve productivity in the business. So that's in my finance function, for instance, where we have a number of different finance systems and we'll consolidate down to one. It's not very exciting. In HR, we're consolidating onto a single software as a service platform, Workday. We've done the UK rollout, we'll roll out more broadly. So there's a whole lot of back office type activity that requires investment, and that will drive productivity benefits in 2014 and onwards. And then it's products, as Ken said. So there's a series of product investments that we'll invest in as well. So we think it's worthwhile to provide an outline really of the sort of investment we plan for 2014, which we hope will help to generate the earnings growth that we're expecting from 2015.
Thank you very much.
Actually, just an anecdotal point on Zuba. I like this story. So earlier this week, a CIO from one of the well-known insurance companies came in to talk to us, sort of just generally. Actually, it wasn't only about Zuba. We got onto the subject of Zuba, and Andrew Binns, who runs the technology services business, was actually in the meeting, and the CIO was inquiring about the progress on Marsh and also inquiring about the progress on Everest Re. And they do plan, in fact they're an existing user of Genius, which of course is a legacy product. They do plan to ultimately transition, and the CIO said, you know, we've looked at the two competing products, and I won't mention their names, but you know who those two competing products are. And she said they just don't do it in the way that Zuba does. She says, but the problem is that they want to see progress really on some of these implementations. I think it's inevitable that that's why I think the Everest Re win was a really significant win for us, because the fact that we're able to do that in the US market will encourage others on the back of that. So as David says, it's going to be a slow burn on some of these things, but I think long term the potential, we have absolute confidence in the long term potential of the product.
Move to a broader base of customers, and that means that a lot of the contract wins that we get these days don't necessarily hit the radar screen in terms of stock exchange announcements. So what we're launching today is a new IR vehicle which has gone to the analysts in the room. You probably haven't had a chance to see it yet because you are out this morning, which is a digest of some of the more important trade press releases collated by heading. So contract wins, new product launches, and a couple other headings. And that's really just a pilot to see whether this is helpful for you. So when you have a chance, have a look at that, and based on your feedback, we would propose to send that out on a quarterly basis. So So I look forward to hearing from you about that. So if there are no more questions from the floor, thank you again very much for turning up on this very busy day, and I'll draw the meeting to a close. Thank you.
Thank you.